Our next, first of all, thank you for being here. I know that we've said that before, and we so appreciate you being involved in government, and what a great, Todd just did a great job for us. We're going to now talk about budgeting. One of the necessary evils that you need to do in your job, and it's something that's going to hit you right away within probably the first month. You'll be talking about that and preparing that as you take the oath of office. Today, we're going to hear from Dean Lundell. Dean Lundell is Finance Director of the City of Lehi, Utah. Of course, Utah. This is how much I appreciate Dean Lundell. I live in Pleasant Grove. He was the Finance Director in Pleasant Grove, but I worked in Cottonwood Heights. I was a city manager, and I stole my hometown Finance Director to be my Finance Director in Cottonwood Heights. And then he decided that he didn't like the commute over the top of the hill any more than I did. And so he ended up, and now he's the Finance Director of Lehi. He does a great job. And no one that I know of can talk about some of the complex concepts of budgeting then in a way that I can understand, which is important. So if I can understand, I'm sure you can understand it. So I'd like to turn the time over to Dean.
Thank you, John. I'll introduce myself just a little bit. Yeah, I didn't realize there's going to be this many people in this many locations. That makes me a little nervous, but it's good to see everyone. John mentioned I've been at a few different cities, and I've been, I think, a finance director at 4 different cities now. I don't know if that's a good thing or a bad thing or what that says about me, but I've been doing this for a while, and I really enjoy it. And I think finance for governments is probably something that's not very well understood, even by people who generally understand financial information and financial numbers, because we do things a little bit differently. What I would like to do today is, so I'll start off. I have some ideas of things I would like to talk about. I've been through a lot of budget presentations and a lot of discussions with elected officials on things, and so that's kind of been the basis for what I've prepared. But I also know that there's probably a lot of questions that or things that you'd like to talk about or have some information about. And I would hate to sit up here for 45 minutes and talk about things that you're not interested in or that aren't helpful. So please ask questions or ask about things you'd like to talk about, and I'm happy to talk about whatever. So. All right, so what I've done, I want to spend the first section here talking about 2 things. One is just a brief overview on government finance, which I'm sure none of you, when you were 18 years old, ever thought you'd want to sit for 45 minutes and talk about government finance. It's the only thing that's more interesting than regular finance is government finance. So, but I do think it's important to understand a little bit why governments budget, why governments have accounting that's a little bit different than private sector. I think it'll make sense as we talk about it. And then I want to talk just generally on what you're going to be doing in the next few weeks here, which is starting your budget start your budget discussions. I've been through a lot of those as well. And I do know, especially when new elected officials are starting out, that sometimes it's a little, I don't know if intimidating is the right word, but it's just new, right? And so hopefully I can say a few things that'll help you ask better questions or want to know some of those things. And really a lot of it has to do with city budgeting is just the fact that we have, not all dollars are the same. So some dollars can be used for anything and some dollars can only be used for restricted things. So we'll talk about that a little bit. We have regular governmental activities that cities do, like police and fire and parks. And we also have specific things that a lot of cities do, like water and power and sewer, things like that. But I think that'll take maybe half of my time. And then the other, I put some topics on there that I think would be interesting. But if you'd rather talk about something else, or if you see some of these things and you think those would be interesting to learn about, truth in taxation has to do with property tax laws here in the state of Utah, which before I started working for a government, if you asked me how property taxes work, I would have given you an answer that would have been very, very wrong. So if you're new to this, some of this may be new. Impact fees, which are really controversial and a lot of people don't like them. And but we can talk about how those work. Redevelopment areas, as far as how cities incentivize businesses to come to their area and how those work, and just bonds in general. So there's a decent chance that some of you will be involved with borrowing money to build buildings or build parks or build whatever, build sewer systems, water lines, and how those work, I think, are interesting as well. So let's just talk about basic government finance right now. So why government accounting and finance is different than private sector. And really, if you look in the literature, like what's published by Government Accounting Standards Board, they talk about a measurement focus. So the measurement focus for a government is different than measurement focus for a private company. A private company, the reason you have financial statements for a private company are probably two things. One, to tell what that net income of that company is. Are they successful or not? And two, how are they treating the resources that are given to them by the owners, whether it's private owners or investment owners. Well, for government, we don't really have the same thing necessarily, right? I always use the example and say, if you're a private company and you have a large net income, that means you did really well during the year. But if you're a government and you had a large balance, net income, if you say, that doesn't necessarily mean the government was successful, right? It really, because the question as a citizen, I would ask, if you got a whole bunch of money and didn't spend it, you either didn't need it in the first place or you didn't provide the services that you said you were going to do. So net income is not necessarily the best measurement for how our government's doing things. What you're really trying to measure is, did that government use the resources, the money that they received, in the way that benefited the citizens as directed by the city council, by the elected officials, right? And so net income isn't really a number we use in government accounting. We use terms like fund balance, meaning you've been allocated certain funds, how much of those funds are left, and how are those used. So we use terms like, instead of revenue and expenses necessarily, we might use terms more like sources and uses of funds. Government environment. Now, I'm used to doing some of this because I teach a class on government finance through BYU's EMPA program. And this is, the next couple of slides are just from Governmental Accounting Standards Board, but I think it describes well why it's different again. So the organizational purpose of a government is really different than a private company, right? We're here to use resources for public purposes and serve the public. And generally, whether or not they're profitable is not necessarily the issue. In fact, by and large, most of the things that governments do are things that don't make sense to do in the private sector, right? There's not really a fire department private model that would work, right? I've lived in the same house in Pleasant Grove for 25 years. I pay property taxes every year. Fortunately, I've never had the fire department come to my house. And so if you had some type of model where the fire department billed you when they came to your house, that probably doesn't work very well, because you might only use it once every 30 years, but you get a bill for $150,000 or something like that, right? So it just doesn't really work necessarily. Also, the sources of revenue. So the money we get from as government, a lot of it's from taxes. It's not necessarily people willingly paying us money. It's not an exchange transaction, which is the term that we use, saying that I give you money and you give me some type of service or product. It's based on taxes, so we account for them differently. Potential for longevity. Governments really don't go out of business, right? Even if they're operated poorly, they don't really go out of business. So we hear sometimes of governments going bankrupt, declaring bankruptcy, right? But they don't end. The city of Detroit declared bankruptcy a few years ago, but it didn't cease to exist. And even if a city ceased to exist, there's still people that live there that have the right to certain services, right? And so they don't really go out of business. So it changes the focus. Our relationship with stakeholders. We have different stakeholders as a government than we do with a private company, right? Private company, you're dealing with primarily owners, shareholders, things like that. But as a city, we have residents. And whether they like paying their property taxes or don't, they still have to pay them. And so we have that relationship. And we have an obligation to show that we're being accountable with their funds and we're using them wisely and for the purpose in which they're intended. And the role of the budget is very different for a government than it is for a private company, because that budget that you're going to pass here over the next, every city does it a little bit differently, but by the end of June, you need to have a budget passed. And that budget is actually the law, right? So if the government entity spends more than is allocated, they violated the city ordinance, and that's a big deal. So it's very, very different. And when you look at financial statements that you're going to see, it's not just the results, but you're also going to see how those results compare to budget. So one of the ways we do this is we use funds in government accounting. So what is a fund? A fund is just a way to segregate some of those different activities that governments do. If you can imagine, if you spend much time looking at financial statements, cities are unique this way, right? If you had an entity that was doing a certain thing, it makes their financial statements a little more clear. But as a government, we're doing police, fire, parks, water. To lump all of those into one thing, it kind of mixes those monies together. So we do funds. So you're going to hear terms like a general fund. General fund is just the fund of the city that does everything that's not accounted in another specific type of a fund. But you're going to have, if most cities have utilities, you might have a water fund, and you might have a fund for your swimming pool or your recreation center or things like that. But it's just a way to keep those activities separate. So when you're looking at the financial statements, they are separated out, and it's not all mingled together. Each one of those funds is really an accounting entity. So if you've ever taken accounting before and you have a trial balance and an income statement and a balance sheet, each one of those funds has its own income statement and balance sheet. And again, it's just a way to segregate those resources for a specific purpose. This is a great big chart, and I really like it. I didn't put it together, but I don't expect to memorize it. I'm not going to spend much time on it, but it just, when you look at a report for a city or really any governmental entity, you have all of these different funds here. Whoops, that was the wrong thing to do. There we go. You have all of these different types of funds, 5 different types of governmental funds, 2 different types of proprietary funds. We have statements for all of those. Then they lump all those together in a government-wide statement. And I always joke just a little bit that, again, the Governmental Accounting Standards Board, they've pushed so much for transparency and try to have a lot of information. Most cities, even a city like Lehi, we're an average-sized city, our annual reports, I think 150 pages and things like that. And so it gets actually quite complicated. And I think sometimes the emphasis on transparency and disclosure just adds to it and almost makes it less transparent because people don't want to read a book that big. But I guess the point is just we have different types of activities that we track separately. We even account for governmental funds differently than we account for proprietary funds. So that's why government accounting is really different than private accounting. What I would like to go over, and again, I probably didn't say this at first. Anyone who has questions, please let me know. I know there's a lot of people in a lot of areas, so you're probably gonna have to shout at me if you have something that you want followed up on or something else you'd like to talk about. In the very near future, you're going to start your budget. I know Lehi City, we just finally got our financial statements finished. I went and picked them up from the printer yesterday, so they're done. And in a couple of weeks, it'll be time to start our budget. And it's a big thing to do. And I really want to just give some information on probably what you would be interested in doing. So budgeting, I mentioned this, there's different types of revenues in a governmental entity. Some revenues can be spent for anything. And I kind of refer to these here as general revenues, with the idea that the use on those isn't limited. And so when we think of taxes, things like property taxes, sales taxes, franchise taxes, those are the things that just fund general operations of the government. They're going to fund your police, fire, streets. There's not really a tie to the revenue to what it's spent for, right? but they fund general operations. And the idea that there really isn't a connection, a nexus between who pays those monies and who receives the service. Example I use on this sometimes is I was reading in the, I can't even remember what the article was. There was an article in a newspaper, and I was starting to read the comments at the bottom, which is always a really bad idea, right? Like I should never do that, but sometimes you do. And this comment wasn't that bad, but the person had a comment saying they owned a home in Salt Lake City and they owned a home in Heber as a second home, vacation home. And it was really unfair that I own this home in Heber. I pay more property taxes for the home in Heber than I do than the one in Salt Lake, because there's an exemption for the home for your primary residence. My kids don't go to school in Wasatch County. I don't really hardly use any of those services, and yet I'm paying more in property taxes than the people who live around there that do use those services. And fact is, he's kind of right, but it doesn't matter because taxes are based on a formula, based on the value of your home, based on if it's your primary or second residence, and you pay what the formula tells you have to pay. So there's not really a connection. He can't go to anyone and say, well, it's not fair that I'm paying more taxes than my neighbor, even though I receive fewer services, because there's just not a connection that way. Most of the time we spend on your budget, at least for all the cities I've worked for, are going to be related to the general fund. We'll talk about budgeting for the other funds, but those generally take care of themselves, because if you think of a water fund, you know what your expenses are, you know what your revenues need to be. You help set rates with things like that. But again, where there's that connection between who pays it and who receives the service, it's a little easier to budget for. The general fund, where there's years you get a high growth in revenues and maybe not as much growth in expenses. And sometimes it works the opposite. There's just not that connection. So we're going to talk about general fund mostly. And you may know a lot of this, but you may not. So hopefully this is new to you. Your two primary sources of revenue are going to be property taxes and sales taxes. So in the state of Utah, property taxes is fairly complicated. We can talk about that a little bit more later if you'd like to, but it's one of your main tax revenue sources. So it's based on the market value of your home. If it's a primary residence, then there's a 45% exemption, meaning that you only pay taxes on 55% of the value of that home. If it's a secondary residence or commercial property, you pay tax on the full value of that home. And property taxes is, for whatever reason, people associate property taxes with cities. Did you have a question?
Is your secondary?
Sure. So if it's your primary home, you pay tax on 55% of the market value of that home.
It seems like it should be flipped.
It's just, that's what's in the state code.
Okay.
That's what maybe in the state constitution, I'm not sure, but when the people that be in the state made those laws, and I think that's actually a good thing to point out, is cities don't generally make rules like that. That's all up to the state. We most of the things that we do on tax revenues and laws are just what's in the state code or state constitution. Please.
How are commercial buildings taxed? Do they have to be taxed at 100%?
Yeah, commercial buildings, and so anything that's not a primary residence is going to be taxed at its full market value. But I was just going to say, people really associate property taxes with cities. When a city raises its property tax, even if it's a small amount, it tends to bring a lot of people out. And I've been in a few of those meetings that tend to not be very fun or very pleasant. But it seems like special districts, like water districts, even school districts, maybe have a little more leeway with that. I know Alpine school districts raised their tax a little bit the last couple of years, and it hasn't seemed to cause a lot of consternation. But I've seen cities raise their property tax, even if it's only $5 a year or something like that on the average home, where it creates a lot of difficult and uncomfortable meetings, public meetings. But most of the property tax that people pay goes to the school district, right? That's the biggest one. Like you pay, I don't know what an average property tax bill is in the state, probably $2,000, $2,500. 60 to 70% of that is going to the school district. Probably 15 to 18% of that is going to the city, right? So that's, but property tax is one main source. Probably the biggest source of revenue for most cities is sales taxes.
Can I ask a question before you leave that?
Yes, please.
So apartment buildings that are owned by one entity, does each apartment qualify for the 55% reduction? No.
They do, and I should have said that. So it's actually, even though you could say is a commercial building, that the person who owns it is a commercial entity, the fact that it's providing a primary residence for their renters, it still receives that exemption. So apartment buildings, if you're looking at as a city, if you're looking at revenue, a commercial Class A office building is going to bring more property taxes in than an apartment complex.
Because the key word is long-term rental, not short-term rental.
Yeah, so the comment was that a hotel is different than an apartment building, right? So a hotel is really just a commercial building. Sales tax. So there's a sales tax charged on purchase of all goods. Very few services, some services. If you followed this recently in the past couple of years, there was a huge push by the legislature to tax, like lower the overall lower the overall sales tax rate, but charge it on services and not just goods. And that wasn't received very well. In fact, it was kind of died in a flaming plane crash kind of explosion. And but I'm sure it'll keep coming back. And the logic makes sense, but it's just difficult, right? When you want to tax something that hasn't been taxed in the past. So it's taxed on I'm just going to say it's on goods, not services, even though some services are actually taxed. As a city, we can charge a 1% sales tax. So, the tax rate varies throughout the state, but it's like 7.5% is probably about the average. 1% goes to the city, but it doesn't all go to the city directly. So essentially what it does, it take half of that money and it goes to the city directly. The other half of that 1% goes into a large pool that is distributed based on population. So even though a city like Eagle Mountain that has a fairly large population, but not much of a sales tax base, they still get quite a bit of sales tax just because of their large population. And you're going to find cities like a good example would be, I used to work for Pleasant Grove City. They don't have a large retail sales tax base. So they're kind of a net gainer of that formula, right? Where a city like maybe Murray or Sandy or Orem that does have a really big sales tax base, they're kind of a net loser on those. Lehi City actually works out about even. We're about 1-to-1 ratio on point of sale versus the actual revenue we receive. But it is important to realize if a new, economic development is a big thing for cities, as that new money comes in, not necessarily all of that is going to stay with the city. Some of it is based on population. We have municipal energy sales taxes, this is a tax you pay on your power bill and your natural gas bill. You may or may not know that. You pay a 6% tax on that. That goes to the city. I put in parentheses franchise because a lot of people still call those franchise taxes. So if you hear the term franchise tax, that's probably what they're referring to, even though it's not called that anymore. Real franchise taxes are cable TV is probably the one that's out there that still pays that. And the idea is Comcast or CenturyLink or Rocky Mountain Power or Dominion, they use the city right away. They put lines in the streets or overhead, and they're using city resources to operate their business. So it's justified to charge that. You also see some what they refer to as boutique sales taxes. And these vary a little bit county to county and city to city. A couple of years ago, there was a new one allowed for roads, and it's a 0.25% sales tax. Some of it stays with the city, some of it goes to the county, some of it goes to UTA, but you get a distribution based on that. Again, depending on where you are, I believe Salt Lake County, all of it goes to the county, and it works its way through that way. Same with the recreation tax. Lehi City just recently adopted a recreation tax, which is a small amount. It's 0.1%, but it can be used for parks, recreation, things like that. And it varies county to county. Again, in Salt Lake County, it's done countywide. In Utah County, it's up to each city to do it. But the difference is those first ones, the first property taxes, sales tax, and the franchise taxes, those can be used for anything, right? It's really up to the city council on how those are used. The boutique sales taxes, they need to be used for that specific purpose. And that goes back to keeping those funds separate. Mention that most of your time in budgeting is going to be spent on the general fund because that's where a lot of the decisions are made. And it really comes down to, first of all, you have to figure out how much money you think you're going to get. So forecasting is a big deal with the general fund. And sometimes it's a guess. This whole issue with COVID and sales taxes has really defied all expectations in the state of Utah. So if this were March of 2020, you would have read articles saying, I won't name any names because everybody was kind of thinking the same thing, that we're slashing budgets, we're laying off people, we're freezing wages, we're freezing positions, we're doing all this stuff because COVID is coming up and we're really nervous about what impact that's going to have on our budget. Well, the truth is, this past year, for most cities, sales tax has been phenomenal, like much higher than even a normal growth year. And so you have to start out, again, we're making forecasts in March for the next upcoming year, trying to guess what that's going to be. So the first part is you have to forecast what your revenues are going to be. For most general funds, the majority of your costs are going to be related to people. That's different than maybe a water utility fund where most of the costs are equipment and large projects. But if you think of a police department, 90% of the cost of that police department are the pay of the officers. And so any decision you make on cutting costs in the general fund primarily involve people. I mean, that's going to be the biggest impact, and that's where it gets difficult. And the truth is, not all cities are created equal. I work for 4 different cities, and some cities have growth going on in property and sales tax growth that maybe have options that cities that are maybe more built out or aren't expanding at that same rate just don't have. And so you have to deal with the resources that you have. Personnel costs are a real issue right now. It's not just hospitality or tech or whatever. Governments are having a hard time filling positions right now. Police officers, probably not as popular of a job as it was 5 years ago, right? For some obvious reasons. But not even that. Right now, we're trying to find building inspectors for the city, and it's actually a pretty good job. It's a job you don't have to have a ton of background to get into, and it's a good professional job you can do for a long time. And we have a hard time. Have a hard time filling those positions. It's just not something people are going into. Which, it's just supply and demand, right? If there's fewer people that go into those jobs, it's going to push those wages up. And we're seeing a lot of that. And if you choose not to do that, then you end up losing some of the people that you've trained for the past few years to other cities. And it's really a challenge everywhere now. The other thing you need to look at is your debt and capital expenditures, realizing that you're going to have a commitment to those for the long term. And, once you issue bonds and those are set in place for 25 years, that's just something that's always going to be there, right? When you're looking at what you can cut or what you can do with your budget, you don't really have any change that you can do with your debt. Your debt is what it is. Just like for your family budget, your house payment kind of is what it is. You can't really use less of it like you could save on utilities or eating out, things like that. And capital expenditures as well. Hopefully all of the cities are setting aside a certain amount every year for capital, because that's where a lot of your costs go. And those are the big things. Kind of talked about that already. I just put this in. If you're used to looking at a regular income statement for a for-profit company, this is one area where governments do it different. We show the full amount of the debt service payment as an expense or an expenditure in your governmental funds, and we show capital expenditures, the full amount of the capital expenditures. In other words, we don't capitalize assets and then depreciate them over time. So when you're putting your budget together, think of that way. If I spend $5 million on a building or something like that, that's going to show up as an expense for that year. When you're budgeting what I refer to as enterprise activities, those work just a little differently. And for cities, your enterprise activities really are your utilities. So most cities here are probably doing at least a water utility and a sewer utility and probably a storm drain utility. You may be doing garbage as well. At Lehi, we do power. We have a pressurized irrigation water system as well. So we have, I think, 5 different utilities that we do. And the budgets for those are just different. And in some ways, they're a little bit easier. It's really a fee for service. We know what the costs to provide that service are. We calculate that, and we need to have revenues that match what those costs are. Budgeting on them is just a little differently, again, because it's not necessarily personnel driven, it's more capital driven. At Lehi, we issued bonds a couple of years ago to build a large detention basin for our pressurized irrigation system and distribution lines. It was $18 million. So that's not uncommon even for regular sized cities to have $15, $18 million projects and related to your utilities. But the personnel part of that is not as much. So when you're putting the budget together for general fund, it's really all about personnel. For your enterprise funds, it's less about personnel. And that sometimes comes to a discussion that sometimes I'll get sewer employment people or sewer employees or water employees or power employees thinking, well, right now it's maybe not the same thing, but when you have years where your sales taxes aren't growing and maybe you're not giving wages or pay increases to employees as high as, or not doing them as high as they would like, sometimes they say, well, you could afford to do it to us because we can just build it into rates. But sometimes that gets to difficult conversations. Should all employees be treated the same or not? And really that's kind of up to you how you handle that. Another thing that comes up is how you're matching those rates to those costs. And so I'll give you an example. In Pleasant Grove, we initiated a pressurized irrigation system, meaning secondary water, untreated water that you would use for your irrigation. And we went through a whole process. In fact, we started out where basically all the lots, I think we had it in 2 or 3 categories, like quarter acre and under, quarter acre to 1 acre, and anything over an acre we're paying. So there's just 3 tiers. You paid one of those 3 tiers based on the size of your lot is what your pressurized irrigation rate was. Well, discussions started saying, well, that's not necessarily fair because there's a lot of variance in some of those tiers. So why should someone with a very, very small lot pay the same as someone who with a quarter acre even, right? And so we actually went to the whole process of looking at every lot in the city, determining what the average irrigation, the amount of their lot that they're irrigating would be. And so everybody was going to pay a different rate. So we had kind of a rate per acre, and it would just, whatever your percentage of an acre is what you would pay. And Our public works people spent, I think, a long time doing that. That's a lot of work. I think it's 9,000 or 10,000 accounts that they did that for. And so we took it to council and everything, I thought it would just be kind of cut and dried, adopted. Well, then he got up there and a couple people from the community who had influence and had larger lots, and so their rates would go up, right? They came out and said, well, that's not really fair, because if you think about it, the cost of the system isn't really the water to some degree, and they're kind of right. It's to put pipes through every street in the city and run that irrigation line. So there's really two pieces. One is the amount of water we use, which the truth is, as a city, you acquire certain water rights and certain shares, and you have those available. It's not like if people use more water or less water, there's necessarily a big savings because you're pumping the water out yourself, right? And so they came and said, well, most of the cost of that system is just the infrastructure to put in the line. So really everybody should kind of pay the same. And so then it went, like I said, to some degree that's logical, but if you're trying to allocate costs based on fairness, I guess what I'm trying to get at is fairness is a subjective term, right? And they went through the whole thing and they said, well, you're right. So we just went back to the way we were doing it before. But in other words, saying, yeah, there is probably a cost for a very large lot versus a small lot, but if we just had 2 or 3 tiers, that would be close enough, which is what they ended up doing. So you really need to look at what's driving costs. Is that how you're going to base your rates? Water is a big issue right now in the state, right? With drought, and pressurized irrigation is a bigger issue because for communities that have both, really your indoor culinary water doesn't really vary. For my house, it doesn't vary hardly at all throughout the year, right? Because it's just indoor water usage. It's that pressurized irrigation, and most cities don't have secondary meters, or they're not metering that. And so that's a big issue. I think over time that will change, and cities will need to. And I don't think cities mind metering it. It's just the cost to put in meters. For Lehi, I think the cost to put in meters of all of those connections it's like $20 million, something like that. So do you base it off of who's using the water, or do you base it off of the cost structure? And those are decisions that come up when you're looking at utilities. Road funding, I put this up there because road funding is an issue very often in most cities. You look at things like power, water, those utilities, it's kind of easy to say, well, costs are growing, we can increase the rate a little bit that everybody's paying. But for roads, it's not the same, because the funding mechanism for roads is very different than the others. We have Class C money, which is money that's paid at the gas pump. That's really a state tax, but they give some of that money back to the cities to do road projects. We have that road sales tax that I mentioned earlier, but the truth is that's not really enough to maintain all of the roads in the city. It's actually really a struggle. If you think of how roads are built in a city, other than the main thoroughfares, most roads are built by developers. So you put in a subdivision, the developer has to come in and build all those houses. We tell them you need to build all these roads, and then they turn those over to the city, which is great. But then city has to maintain that forever, and there's not necessarily a revenue stream coming in to do that. You can't just raise, again, when there's not a fee that you could raise a little bit, it's hard to come up with that money. And I know that was a real issue in Pleasant Grove. I think it's been an issue everywhere. Lehi is maybe a little different, where we're so new and so many of the roads have been built just very recently that we don't have that problem, but we're gonna have that problem in 20 years probably. So road funding is probably an issue, and I don't know that I have an answer for you, but just it's going to be a struggle. It is roads, depending on the city, but it is important to maintain those roads. And your public works director will probably come out and show you a graph and talk about that. If you have a brand new road and you put the maintenance on it over the first 4 or 5 years, that road's going to last a long time. If you don't, it's going to last a lot less. Kind of the example is if you buy a new car and maintain it and change the oil and do all those things regularly, it's going to last for a long time. If you just buy it and don't ever change the oil and don't do those things, you might think you're saving money, but you're not saving money, right? Okay, so we've still got about 15 minutes, and I can go into some of these things, but I am curious if you have any topic you would like to discuss or any question you would like to ask over any of the things that I brought up here. If not, we're going to talk about property taxes and truth in taxation.
Warren has a couple of questions.
Please.
What are the laws surrounding rainy day funds and how much cash on hand a city can accumulate?
Yeah. So the only limitation or laws on rainy day funds or reserves is related to the general fund. So any of your utility funds can build up as large a reserve as they want. For the general fund, you have to have at least 5% of 1 year's worth of revenues as a reserve. You can't have more than 35%. That's actually jumped up a lot it used to be 18%, then it jumped up to 25%, and this past year they've jumped it up to 35%. Now, you can deal with that a lot of ways. So if you have excess money in your general fund, you can see that that's going to happen. You can transfer it into a capital projects fund to build a future building or road or things like that. So there are ways to deal with that, but you can't have less than 5% and you can't have more than 35%, or you'll get a letter from the state auditor's office. Was there another question in order?
Yeah, I've got one more. What financial tools or incentives do cities have to try and attract business?
Yeah, so let's just jump up there really quick. I've got a couple slides on redevelopment areas. So yeah, as a city, when some of these big companies come in, like Adobe or, the names escape me now, but the big building that was just built in Draper, Pluralsight, yeah, that was up there. So a lot of times cities are really anxious for those entities to come into the city. They bring jobs, they energize cities, bring in tax revenues, bring in people. So the law in the state of Utah related to these areas has evolved quite a bit over the 20 years I've been doing this. It used to be pretty free form that the taxing entities that were around those properties, they could make a lot of deals with those developers or entities that are coming into the city. It's become, I think, more restricted now than it used to be, but essentially it just works like this. I'm going to use the most basic one of if it's just a city and you're just going to, as a city, incentivize a business to come in. You'll set that up as a separate area, which we call a redevelopment area. So that redevelopment is actually a separate legal entity. And even though the board of the redevelopment area is also the city council, you're going to have separate meetings. So you might be at a city council meeting sometime and they say, hey, we need to stop this meeting and go into a meeting of the redevelopment agency. And so again, it's a separate entity. But what will happen is if that redevelopment area is able to negotiate with that developer and say, hey, you're going to pay your sales taxes or your property taxes, but the county is going to take those property taxes, kind of put them in a different bucket. And some of that money can go back to you as a developer to help reimburse costs that you otherwise would have paid. So as a developer, you come in, you're going to have to build sewer lines and water lines and give up right of way for roads and all of those things, pay impact fees, pay building permit fees. As a city, you can't really just waive those. Like everybody needs, like we have to treat all people equally, but through this redevelopment area, you're able to set aside some of that money and repay them for some of those costs. It has to be for public infrastructure. Again, 20 years ago, we would just write checks back to developers, and it wasn't necessarily tied to infrastructure, but now it's really needs to be tied to infrastructure. So all the redevelopments we're doing, it's like, we're going to keep track of the public infrastructure that you had to put in, that you're required to put in, and we can pay you back some of that based on the property taxes that you paid. Now, as a city, again, our property tax portion is only maybe 15 to 18% of the total property tax. So it works a lot better if you get the school district to participate too, right? So if the school district is willing to do the same thing, then they can get more of that property tax back to them to help reimburse them for their infrastructure. But really, that's what it is. Now, you can do enticements with sales taxes. We have a couple of those with the city where you can rebate some of their sales. But again, it needs to be tied back to a benefit to that area, not just as money back to the developer.
Question in
Yes,
Cedar
please.
City. Can you talk about transient room tax? Is that a source of funds for the general fund, or is that something different?
Yeah, so when you talk about room taxes, there's really two. One is charged by the county, and that's the larger portion. And those, I'm probably not a real expert on. I know a large part of county budgets are funded with those. They tend to do, I don't know if there's really a lot of restrictions on them. Cameron's just speaking, yeah. Yeah, so there are restrictions on how they use that. And I'm, be honest with you, I'm not an expert on that. But as a city, we charge a 1%. In addition to sales tax, there's a 1% room tax that a city can charge that is general tax money, can be used for just general purposes. We'll let Cameron answer the one as we close here. Anything else? Okay. So I've got 7 minutes, and I'm going to teach you everything I can about truth in taxation in 7 minutes. So I put these together for our city council a few years ago, and hopefully it's helpful. I've been through it a few times. So if you ask me before I start working for a city, if my property tax goes up as the value of my home increases, I would have said yes. And it wasn't until I worked for a city that's not really how it works. So I want to use this example because it's actually really important that you understand it. So if I have just a sample Utah town here with 10 houses, every one of those houses is valued at $300,000. Remember, we have a 45% exemption because it's everybody's primary residence. And they have a property tax rate in that town of 0.2%. So if I take 300,000 times and subtract 45% from that, times it by 0.2, I get $330. So we're going to say every town in that house pays $330. So there's our 10 houses. So the first year, everybody pays $330. Our town revenue is $3,300 for that year. Okay, pretty straightforward. Let's go to year 2. We still have our 10 houses. But this year, every house in that town increased, its value increased by 10%, went to $330,000. So that's where we put into place what is referred to as a certified tax rate, which is based on appraisals from the county, and the state helps us calculate that. And it's saying, okay, town, your certified tax rate is going to decrease from 0.2 to 0.001818. Okay. With the result that if I take the 330,000 minus the 45% exemption, times it by 0.0818, I still get $330. So every home is still paying $330. Their home is higher value, but the tax rate is lowered. And what the certified rate really means is that's what defines is whether or not you're doing a tax increase. So if you charge if as a city you choose to charge that 0.2% rate still, you can, but you have to declare that it's a tax increase. Okay. If you want to just stick with the certified rate, which is what most cities do, then you're going to get the $330. And the issue that comes down is, as you know, especially in a year like this year, we're going to have CPI inflation that's 6.5%, right? There's not inflation built into that certified rate. If you always went with the certified rate forever, you'd always get the same dollar amount. You only get increased money as new things are built. So let's go to year 3. Now we have 12 houses. Again, it's valued at $330,000. The houses didn't increase in value this year, so the certified rate remains the same. So every house is still paying $330, but now our total tax receipts went up because I have 2 new houses. Okay, so that's how you're going to increase. If you stick with the certified rate, the only way you're going to get new dollars in property taxes is through growth, through new things being built in the city. And that seems kind of straightforward, but where it gets kind of confusing is we'll do this in year 4. Let's say in year 4, half of the city, the houses increased by 10%, and the other half of the city, the values decreased by 10%. So if you think about it, as a city, the total value didn't change, but just some went up and some went down. And so we have 6 homes valued at $363,000, 6 homes valued at $297,000. Our certified rate didn't change because the total value is the same. But what's changed is 6 of those homes are paying $363 now, and 6 of those homes are paying $297. So as a city, we get the same, but that one half of the city is going to think they got a property tax increase, right? And I've been in some of those. And it gets even more complicated because this is a very simple example, and we're just talking about one taxing entity. But think about those homes, they don't just pay tax to a city, they pay it to a school district and a county, probably Central Utah Water Conservancy. And so all of those things are going on at the same time. And so just because your property tax goes up doesn't mean that any business necessarily raised taxes. It could just be the value of your home has gone up higher in proportion to the rest of the city. And I really admire our county assessors and all the people that do this. They have what, 5 months to value everybody's home, calculate all the certified tax rates, and do all this. And it's obviously they're not looking at every home, but they're doing a value on every home, and it's a lot of work to get that done. And so when you're looking at property taxes, I think the main point of this is just to realize that you're not getting new revenue unless you get new growth. A property tax increase, as unpopular as it is, in my opinion, is necessary every few years. And even if you talk to the Utah Taxpayers Association and Howard Stevenson, who kind of wrote the law on truth in taxation, they would even say, I've heard them say this many, many times, that it's something that probably should happen every few years. I don't know the number, but 3 years, 4 years, 7 years. Because if you don't, as your costs are inflating for people and for equipment, you're not keeping pace. Now, there's other ways to keep pace with revenue growth, maybe through additional sales taxes or other things, but your property taxes are not really keeping pace with inflation unless you go through this process periodically. The reason they call it truth in taxation, I probably should have led with this, is just the idea that if you want to do a property tax increase as defined by the state, then you need to go through a process which includes some public hearings and things like that, and advertisements that tend to bring out a lot of people and not be very fun meetings. I've been in a few of them. So, and I would just advocate, you're a lot better doing it every 2 or 3 years for small amounts than doing it once every 15 years for a huge amount, because it tends to be what cities do is you get back to a corner and I don't have any choice but to do this. And so I've got to raise it a lot because we haven't done it for a long time. And that's kind of when those things go south. But I think my time's up. Cameron can answer that question on county transient room taxes. And I think I'm done.
Perfect. Thank you, Dean. And thank you for the expertise that you shared today and really share with cities across the state. When we talk about who is the league, well, Dean and his colleagues within the Utah chapter of the Government Finance Officers Association are valuable pieces of the overall league team. So the question came from Cedar, right, on TRT. So can you ask the question again? I made a star. You wanted to talk TRT, but will you ask the question again?
So I'm just curious about how TRT works, if the cities get much of a benefit from it, and if it goes into the general fund or if it's specifically designated for something else.
Perfect. So Dean answered about the city TRT. The county TRT is a little different ballgame. So the county imposes a transit room tax, and state law actually outlines exactly a percentage of what of the TRT dollars have to be spent on promotion versus what can be spent on other uses. For example, to mitigate the impacts of tourism or to build facilities that are related to tourism. The counties ultimately impose the tax and make the determination on how those dollars are spent. That TRT money is subject to dialogue at the legislature every year. In fact, just earlier this week, Sean Guzman, who you met earlier, is down in St. George. He and I were on phone calls talking about potential changes to TRT in this upcoming legislative session. And that's one thing I wanted to add to Dean's presentation when he was talking about sales tax and property tax. There's never a dull moment in the taxation world. Roger, too, who's staffing Logan for us. Roger's a retired tax commissioner and has been with the league now since 1996, right, Raj? Do I have the year right?
Yes, that's 1996.
96. Okay, so since I was in junior high, Roger's been working with the league. That's why I wanted to set it up, Raj. But Roger is the foremost expert on tax policy in the state. And because of the efforts of people like Roger and the league, when Dean referenced the quarter-cent for sales tax, or quarter-cent sales tax for transportation, we were instrumental in getting the legislature to authorize that tax on behalf of local governments. So you couldn't just go out and create your own sales tax. You have to have state approval. But we brought together cities across the state to get that authorization, which then has been invested in communities all over the state. The other thing I wanted to quickly bring up here is we're going to have a minor schedule change in light of the fact that we've had lots of questions, which is awesome. In most sites, lunch has been delivered. So what we're going to do now is, instead of having a break and another presentation and then lunch, is I'm going to just quickly take a moment to talk about local government partnerships. Then we'll just break for lunch, and it is going to be a working lunch. But we'll break for lunch, give you a chance to stretch your legs, mingle with your colleagues, and then we'll come back, and Justin's presentation and the Matt Dixon presentation will be flipped, but we'll make sure we're back on schedule so that when we get to 1:15, we'll be on schedule, because the most important part of any league event is to do our darndest to end on time, especially on a Saturday. But we appreciate the dialogue that we've been having here today. I wanted to take a quick moment and reference some of the partnerships that you have access through the league. So obviously Utah State is a big one. That's why we're using their facilities right now. In addition, though, to the partnership on the training, we are a founding member of the Institute of Land, Air, and Water. Jen mentioned that beginning, but that will have its official kickoff this week, right? Tuesday. Got it. So that institute is going to be the voice, the go-to voice for state and local policymakers around land, air, and water issues, and we're a founding member of that. We're also partners with the Gardner Policy Institute at the University of Utah. They do economic-related data and housing-related data. We get a lot of information from them, and we share it broadly. We are on the board of the Utah Foundation. We partner with them on policy research on a regular basis. We are partners with the Utah Women in Leadership Project through Utah State. We are partners with Get Healthy Utah and provide grant dollars through different partners to communities that are engaging their residents in a way to improve community health and individual health. We are partners with the Utah Clean Air Partnership, which provides resources for cities to try to tackle the air quality challenges that we have in the state. We have partners with associations of government. Some of them will be stopping by your different sites today, but there are associations of government across Utah that bring together mayors and council members and county commissioners, and they provide, in some cases, metropolitan planning. So your association of government and your metropolitan planning organization are one and the same, but it's a way to look regionally as we try to plan our areas. So we have those organizations like the Wasatch Front Regional Council and Mountain Land Association of Governments, the MPO down in southern Utah, and there's an MPO up in the Cache Valley as well. And then the AOGs are all over the state, and they provide different services. And we partner with them, again, trying to ensure that local government voices are being heard across the board. We also partner with chambers of commerce. I mentioned that transportation bill a few years ago. That's one of the highlights of my career, was getting that bill passed. And we got that bill passed because the business community and government officials from across the state went to the legislature and said, we need this tool to keep up with the challenges of growth that we are facing. So it just gives you a sense of some of the partnerships that by belonging to the league, you'll have access to. We also have a large variety of corporate sponsors. So when you come to league conferences, you'll meet corporate sponsors that can provide consulting work on public finance. You'll meet corporate sponsors that provide services and other goods, public works type vehicles and other things. And those sponsors help us pay our bills, but they also provide a valuable service to you as cities, and you'll see them at league conferences, and they'll be highlighted in our podcasts and other communications. So that just gives you some of the examples of the partnerships that we have here at the league. So with that being said, my last point is this. Mayor Don Ramsey, the league president, will be here shortly. We're going to break for lunch. And so we'll plan, it's currently 11:33. We'll grab your lunches. Even if your lunches haven't arrived yet, just stretch your legs. And as lunches arrive, we'll be staying in touch with league staff. Once lunches have arrived, or in about 20 minutes, we'll come back and continue through our agenda, and Mayor Ramsey will welcome us back. So thanks, everybody. Enjoy the break, grab your lunch, and we'll see you in a few minutes.